Every day you see headlines of startups raising millions or billions, huge valuation, and founders celebrating investor money. But I'm doing completely opposite. We're growing quickly, but we've never raised a single dollar from an investor. Hey everyone, I am Bo, co-founder of Savinoma, and recently we've crossed a $500,000 in annual recurring revenue. My startup is doing around 70,000 per month and fully bootstrapped. At Savvy Nomad, we help Americans who live abroad pay less taxes back in US. We're small, efficient team, just two co-founders, one full-time employee, and we're growing consistently 15% to 30% month to month. In this video, I will share my personal experience, how I tried to fundraise in the past and why it didn't work out. I will also share why we decided against raising funds for Savvy Nomad, my personal thoughts on venture funding, and why bootstrapping is the best choice for us. Finally, I will share my own recommendations to help other founders with decision either to raise funds or bootstrapping. Let's get started. When you're considering venture capital funding, it's important to understand what you are signing up for. Venture capital is high-risk investment model, and investors always looking for 50x, 100x returns. Because of this, VCs often looking for startups that can generate these returns, either unicorn status, huge acquisition, or large IPO. They usually aren't interested in small yet profitable exits, 10 or 20 mil. It's just too small for them. Once you raise venture funding, there is no way back. You will have a pressure to grow as fast and as aggressive as possible. Even so, it might be not the best choice for your business and your stage. Often investors will push you to raise again and again and again, not because you need this money, but because next round usually increase your valuation and they need to report to the investors that their portfolio is growing. Another major downside of this path is that you will lose control of your company after each round. Every round dilutes your ownership and autonomy in your business. Even if your startup receives a great acquisition offer for 10, 20, maybe 30 mil, often for VC investors, it's just not enough and they're targeting for high returns, so they might just block the deal, and for you as a founder, might be life-changing money. Additionally, once you've entered venture path, there is no way back. Raising capital sets a speed and growth expectations that usually can't be reversed. You've committed to either grow big or eventually failing. There is often no middle ground, and usually there is no way back to sustainable, profitable growth. Venture investors are also extremely trend driven. Right now, it's all about AI. Startups outside of current trends usually struggle to raise funds and get some attention from investors, so usually they are forced to pivot or follow the narrative of investors. Investors leverage trendy narratives to justify higher valuations, often ignoring companies outside of the trend, even so it might be profitable, high-growth business. Ultimately, the venture-backed businesses play so-called finite games. The goal is clear: to win big, to capture the market, to exit. This approach has a very different mindset compared to bootstrapping. Personally, I've experienced how frustrating fundraising game can be. With my previous startup, also about taxation but in different niche, experience was very depressing. We were ghosted a lot of times. We had a lot of meaningless meetings. We often spoke with interns or analytics who didn't give a shit about our business, and I had a feeling that they were on the call just to hit their quota. Because we didn't have impressive logos in our CVs, we didn't have exits in the past, and we were outside of the trends, we struggled. We ended up wasting a lot of time and energy on this process, and we diluted our attention from building product that our customers need and market it. And in the end, it was one of the major reasons why we failed. After that experience, I from it myself, avoid venture funding as much as possible. Distraction and emotional toll just weren't worth it for me. If you're curious about how I failed my previous startup and what lessons I learned, I will leave a link to a detailed blog article in the description. Bootstrapping is a different approach when from day zero you avoid to raise funding and focusing on building product and sustainable revenue that you can reinvest back to the business. Historically, bootstrapping was very difficult because even for MVP, it was required to have an engineering team or upfront investment in order to launch early version of the product. However, today with accessible no-code, low-code tools, and especially AI, the game is completely different, and it's never been easier to launch products than now. Sometimes bootstrap startups raise initial funding from angels or bootstrap-friendly funds like Tiny Seed, just kickstart their journey. And I know a few founders who got money from Tiny Seed, and following this hybrid part, they were able to have some cash at the beginning to launch and continue growing. And now they don't need to raise the money, they have a profitable business. I'm not sure how I feel about it, but again, that's one of the options. Bootstrapping isn't suitable for every business. Some products need a huge initial investments, like fintech for compliance, for licenses, some AI deep tech hardware companies to build the product in the beginning, to invest in R&D, and it's fine. If you want to bootstrap, you can find other business models, other markets where it's not required. It's completely fine to avoid these industries or products, and instead it might be a good industry for next attempt when you already have some capital to invest at the beginning, or you have some experience and traction so you can raise money. When you bootstrap, you've closely connected to customers, to their pains, and you're focusing on monetization from day one just because you need it for survival. But there is a clear downside. At the beginning, you need to burn your savings in order to keep running your business, to invest in marketing, in product. Often you won't be able to pay yourself salaries for a significant time. For example, in our case, in Savvy Nomad, we've received first salaries after 18 months of working together with my co-founder, and he was working on this business even 6 or maybe 10 months before me. Realistically, we could probably pay ourselves salaries maybe 6-10 months, but we decided to invest more into marketing and into product. If you don't have savings, earn money first, get the job, build some other maybe service businesses, because if you don't have money, you don't have savings, and you think that you need to raise money, I have a bad news. You will also struggle to raise money, and investors, they also feel when you need this money and when you struggle. Bootstrap startups operate what is known on infinite games. You play just to continue playing. You're focusing on building sustainable revenue, profitable business, and yes, you might be happy with an exit, you might look for these opportunities, but it's not necessary. You have other options. One of the most significant benefits of bootstrapping is that you maintaining control of your own company, of your own business. Without investor pressure, you can make a decision based on your business needs, based on your lifestyle. You are free to live wherever you want, to have a lifestyle that you want. You don't have pressure to work 12 hours a day, 6 days per week, just because investors expect these crazy returns from you. I deeply appreciate freedom and discipline that bootstrap business offer. While we might not take aggressive bets like some other venture-backed startups can afford to do, we are growing at a stable pace, and also it's aligned with What type of business do I need? With a balance, profitable, not pushing myself too hard. It's sustainable, balanced, and just enjoyable. So why we decided not to raise money and bootstrap? When I first joined my business partner, his intention was clear. He didn't want to raise money. He had previous experience with startups when, because of dilution, ultimately he lost control of the company, of the board decision, and the company went to a direction that he wasn't happy with. This experience left him dissatisfied, and as a smart person, he decided to learn on his own mistakes. But beyond this personal experience, we also had a practical reasons. The main one was simple. We don't actually need to raise money. We were able to build our product with current no-code, low-code tools with AI automation. We were able to reinvest revenue from the beginning back to the business. We were profitable quickly and were able to reinvest money back to the growth without need to spend our time and dilute ourselves to raise funds. Additionally, our startup doesn't feed current AI hype. We are serving remote workers, nomads, people who moved from the United States, and recent years we even see in media like anti-trend a lot of huge companies returning back the employees to the office, and it makes raising money even less appealing. Another significant reason for us is flexibility to accept a good acquisition offer, even if it's not $1 billion exit or IPO. We've realized clearly that if we will follow venture pay paths, we will be blocked to exit early. And to us personally, to have an opportunity to sell a company and walk away with a few millions might be a life-changing opportunity just to be able to retire, to support our families. And if we would have investors on board, we probably wouldn't have this option. It's also worth mentioning that since I'm building in public and sharing all of the metrics of Savvy Nomad, we received around 10 inbound requests to invest in our company. We've politely declined, we're not interested. We still consider small chance in the future that we might need some capital in order to acquire other companies, maybe for some aggressive expansion, but to be honest, the chance is really small. Lastly, and this is what I appreciate the most, is my lifestyle and the pace and stress levels that we have. Yes, the stress is involved. Bootstrapping is not easy, especially at the beginning, but it's a sustainable, healthy type of a stress. We maintain a fully control of our lives, our schedule, and our decisions. I deeply appreciate having an opportunity to have some days off, hike mountains, explore jungles, visit Antarctica, and just to spend time with my friends or family. As a nomad myself, I know that this level of freedom will be really hard to maintain with venture investors on board. Especially all of these all investors are very biased in terms of its classic office setup and no remote work. If you're interested in seeing exactly how we grow, I publish monthly reports with all of the metrics, failed and successful experiments in my free newsletter. I share my journey to 1 million ARR with occasional deep dive posts. And also you can follow me on LinkedIn. You can check links in the description. Ultimately, the decision either bootstrap or raise funding comes down to your personal and business goals. If you can realistically build your startup without any external funding, just do it. Yes, bootstrapping might mean slower growth. You won't be covered by TechCrunch, you won't be mentioned in hypergrowth startups list, you probably won't get into Forbes 30 under 30, but it's all about ego and what your business and you actually needs. But bootstrapping offer something more: control and freedom. It's let you set your own pace, keep decision making power in your hands, and shaping business around markets, your business needs, and also your lifestyle. In other hand, if your ambitions are truly massive, you want to change the world, build a trillion worth company, then realistically, you probably need a significant amount of capital. It's really hard, maybe almost impossible, to scale a company to the level of Nvidia, Apple, Microsoft without any fundings. But you need to understand the trade-offs. There is no universal right or wrong choice here. Only what aligns with your personal and business goals is what truly matters. But for most founders, if your business model allows it, bootstrapping is definitely worth considering. That's all for today. I hope my experience and thoughts will help you to make a better decision with your business, either raise funding or bootstrapping and enjoying life more. If you enjoy a video, give it a thumbs up. Uh, you can also follow my journey here to 1 million ARR and subscribe to the channel. And I'd love to hear your thoughts too. If you have any experience with raising funds, with bootstrapping, or if you have some questions, just drop them in the comments. Thank you for watching and see you in the next one.